Hi, and welcome to this week's market presentation. Latest news. In the latest energy news, we begin with the war in Iran, which continues with no clear end in sight. Negotiations between the US and Iran appeared to collapse over the previous weekend, with the US saying no to Iran's latest proposal. The US ceasefire described now as being on massive live support and rhetoric from President Trump, and reports that the US and Israel are preparing to renew military operations have increased tensions in the region and the prospect of a continued war and a continued closure of the Strait of Hormuz. The US-China summit has so far failed to deliver a breakthrough on Iran. The impact on energy markets was felt with the rapid increase in crude oil prices over the past week, with Brent crude surging above $111 a barrel once again. European gas and oil prices have now hit 4-week highs on the heightened geopolitical risk. Markets are now pricing in a longer disruption to oil and gas flows through the Strait of Hormuz. And we are also seeing greater concerns over rising global inflation and the prospect of an economic slowdown as a result of the negative impacts the war has had on the global economy. As macroeconomic pressure mounts from inflation and from weak Chinese data, a resolution to the end of this conflict is being highly sought after by market participants. China's economic data for the month of April disappointed across the board, primarily when looking at retail sales and industrial production over the past month. Over in the US, inflation ticked up to 3.8 percentage points over the course of April, with the recent increase in inflation over the last couple of months the fastest increase in inflation since the peak of the inflation rise during the COVID pandemic. Markets are now pricing in a roughly 70% probability that the Federal Reserve moves forward with an interest rate increase by December of this year. The recent economic developments will certainly put the new Federal Reserve Chairman Kevin Warsh in a difficult position. Weather. Moving towards the latest weather forecast, temperatures across most of Europe are forecasted to move noticeably above seasonal average over the next 7 to 10 days, bringing additional heat and, as a result, cooling demand across the continent. Precipitation is continuing to be rather limited, especially looking at the Nordic region, although looking at the end of this week and early next week, we'll see some greater precipitation in that region. For the rest of Europe, limited rain over the next 7 to 10 days. In terms of average wind speeds, we're seeing relatively modest wind speeds over the course of the next week. Crude oil and LPG. Looking at crude oil prices, we definitely highlight the large volatility in the market, with prices moving up and down very swiftly from week to week as a result of the evolving reporting and headlines on the progress to end the war in Iran. Over the past week, as tensions rose, crude oil prices saw notable gains, with West Texas crude up 10% on the week and Brent up just under 8% on the week. The EIA now expects for supply disruptions to last longer into the year, now impacting the third quarter of 2026 more severely, turning the latest forecast for the supply and demand balance in the third quarter of this year from positive to significantly negative. This is also in the face of the continued withdrawals from strategic reserves that IEA members, particularly the US, have done over the last few weeks, with the US having so far released roughly 51 million barrels of oil, and the total release from strategic reserves from IEA members up to 160 million barrels of oil. Nonetheless, as those storage levels continue to be depleted, there will certainly be even more pressure on the supply and demand balance in global crude oil markets. Natural gas. Looking towards natural gas prices, we see the increase in the price level most noticeably felt in the short term. Prices for the third quarter of 2026 saw a roughly 13% increase week over week as the prospect of the continued block of transit through the Strait of Hormuz has persisted. For the front year, the increases were more modest at just 5%, but nonetheless pushing up natural gas prices in Europe to multi-week highs. Storage levels in Europe have continued to increase over the last few weeks, now settling at around 36 percentage points full, nonetheless still below both last year's levels and the average since 2012. The supply-and-demand balance deteriorated over the past week with an uptick in total natural gas demand across Europe, while the supply situation remained largely unchanged at the bottom of the past 5-year range. The tighter supply and demand balance then led to a decrease in the rate of injections into storage, pushing it from slightly above the past 13-year average to now near the bottom of that range. If we continue to see these below average injections and slower increases in storage levels over the coming weeks and months, that will be another bullish factor adding pressure to European gas prices. The European supply mix is now being hampered not only by the disruption to LNG flows through the Middle East, but also by the ongoing maintenance at Norway's gas infrastructure. Nonetheless, progress has continued, and we are looking at relatively more stable evolution of Norwegian gas flows to Europe as LNG sendouts continue their downward trend. Asian consumers continue to pay a premium to secure the tighter supplies of LNG globally compared to European consumers. Investment fund positions remain more bullish, holding noticeably larger long positions in the market on the back of the war in Iran. Coal. Coal prices saw an increase over the past week on the back of rising natural gas prices. Over in Asia, the gas to coal switching that China has been undergoing since the start of the war has led to an increase in coal consumption in Asia. And as China looks to more structurally increase the use of coal across its energy, but also industrial sectors, we could be looking at a more structural increase in coal demand out of China for the remainder of 2026. Over in Europe, the rising gas prices pushing up coal prices as we see some additional gas to coal switching, although limited by the availability of coal-fired power generation. EU and UK emission allowances. Carbon allowances have turned more bullish once again on the back of the rising gas prices and ensuing gas to coal switching, increasing power sector emission expectations. Additionally, it appears that the ETS market reforms will not significantly impact the availability of carbon allowances starting in 2026, keeping the tighter market expectations more heavily anchored in the market. Nonetheless, EEX did announce an additional 40 million tons of EUAs being put up to auction this year, a front loading of those carbon allowances, alleviating some of the upward pressure on the European side of the market. And then on the UK side of things, the ongoing and growing expectations of a linking between the EU and UK carbon markets adding support to UK carbon allowance prices. Emissions from Europe's power sector remained close to the lowest levels over the past 5 years, although we do see sudden surges in emissions when we see dips in renewable power generation. Investment fund positions on the European side of things remain more modestly on the net long side, as there's still expectations that we could see ETS market reform announced later this year. On the UK side of things, the record level of long positions very much due to the linkage expectations between the EU and UK markets. Electricity. Electricity markets, focusing now on the German power market, saw increases over the past week alongside the increases in natural gas prices, although more modest in part due to the more limited gains we saw in carbon pricing week over week. The increases, as with natural gas, were concentrated in the short term, with the third quarter of 2026 up just over 7% week over week. The frontier seeing more limited gains of just under 3% week over week. The uptick in electricity power prices was felt across European markets. And then looking at the Nordic region in particular, on top of the other bullish factors in the market, the lower hydro storage levels in the region, especially in Norway, adding additional bullish sentiment to the market by reducing the hydro power outlook. Looking at total demand and residual load, we're looking at total demand remaining relatively steady over the past week, in line with the past 5-year average. As we look to the warmer and hotter weather coming in over the next 7 to 10 days, we could see a boost in total demand due to cooling needs. Looking at residual load, stronger renewable power generation has kept residual load way down to near the bottom of the past 5-year range. Looking at the European supply mix, we see the French nuclear power fleet performing in line with the levels that we've seen over the last couple of years, steadying over the past week. Renewable output saw an increase over the past week, now in line with the evolution that we saw in 2024, and currently at a record high for this time of year. The stronger renewable output helped reduce demand for fossil-fired power generation, which is now closer to the bottom of the past 5-year range. Looking at renewables more closely, we see that the increase in output over the past week was very much driven by the increase in wind power generation, given the relatively stable evolution of solar power, even as it is performing at a record level, while hydro reservoir and run-of-the-river generation remain near the bottom of the past 5-year range. In terms of fossil fuels, the increase in renewables led to a sharp decrease in fossil gas-fired power generation. The high prices for natural gas also leading to gas-to-coal switching, adding support to coal-fired power output over the past week as well. In terms of hydro reservoir levels, really want to focus there on Norway, which is seeing levels just above the average from 2015 through 2025. Nonetheless, the current weather forecast indicating drier conditions over the coming weeks, weighing on the outlook for storage levels and as a result for hydropower output in the region. And lastly, looking at guarantees of origin, we see a continued bullish price evolution, especially for 2026 and 2027 production years. Overall, on the supply side of things, the poor outlook for Norway's and the Nordic hydropower generation is tightening the supply outlook for guarantees of origin, while on the demand side, the growth of data centers and other large loads are increasing demand expectations for guarantees of origin, overall tightening the supply and demand balance, especially for the rest of 26 and for 2027, adding to the bullish sentiment in the market. That covers this week's market presentation. Thank you for joining.